The Stock of the Day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
So a positive reaction on market today to our stock of the day, PEXA Group, reporting a loss of $32.7 million in the first half, but with underlying cash generation growing, the group's decided to distribute $50 million back to shareholders via buyback. PEXA also flagging that it expects the macro environment and property markets to remain uncertain in Australia and the UK. However, it is reaffirming its FY25 guidance and is looking forward to CEO transition in the second half. Russell Cohen will step into the role at the end of March. I spoke with current CEO Glenn King a little bit earlier today and asked what gave them the confidence to return that cash to shareholders.
The cash that we're generating, we felt it was right to give our shareholders the opportunity to benefit with a buyback, and that is up to about $50 million to be determined from mid-March. So the patience of our shareholders, we want to reward that, and also it recognises the performance we're doing with our customers as a regulated critical infrastructure platform in Australia.
So that was Glenn King there, outgoing CEO of PEXA. As I mentioned, shares up by about 8% today. I'll start with you on this one, Ben. Have you missed the boat in terms of buying into PEXA, if you like the overall story for the company?
I don't think you missed the boat. I think this is one we own and think is a buy, but like just looking at that chart, it has gone sideways. I'll be the first to stick my hand up and admit that, especially over the last year or two. However, this was a business that floated in a couple of years ago at about $17. And yeah, just kind of got the macro and the timing wrong and pulled back a fair bit. It is a monopoly player in, as the CEO said, a critical infrastructure. I like to think of it as the REA, realestate.com, but for back-end property settlements. And yeah, the result today really demonstrated how strong the core Australian property exchange business is going. Which, you know, not only does it have dominant market share, but it's also got volumes picking back up. And yeah, just some of the metrics looking down the screen here, it's EBITDA was 8% ahead of consensus. Free cash flow was $27 million, which was significantly ahead of consensus. And that's kind of what the CEO touched on there in terms of that gives them the capacity to return capital to shareholders. So that's a $50 million buyback, which has been well received by the market, as well as kind of pay down some net debt. So that net debt to earnings ratio has gone down from 2.9 to 1.9. So that's improved the balance sheet there as well. So on the whole, the business is going great. There's still some question marks over the UK expansion. But the third element of their business as well worth mentioning is the digital solutions, which has gone through to EBITDA break even. So that's a good little free kick in the business as well. So although there are some question marks on the UK expansion, these things take a lot longer than you tend to expect. They did announce a good starter deal with NatWest in May 2024, and I was just on the conference call before with PEXA, and they were saying that that announcement enabled some easier conversations over the last few months with those other UK banks to try and really increase the penetration in that market. So, although we've kind of been holding and it's been going sideways over the last year, it's one of these ones where the thesis is still largely unchanged, and it's trading on its lowest valuation over the last 12 months on just 17 times EV to EBITDA. REA is on 29. We think it can bridge the gap if they can prove some good traction in the UK and turn profitable. So still got a fair bit of upside, and we see downside as relatively protected. So especially with this buyback in place, it's a buy for us.
Thank you. What do you make of it, Luke? I had a guest earlier saying that the factors you want right now are quality and also value. So does PEXA hit the mark when it comes to those?
I think so. I mean, to touch on Ben's last point there about the downside focus of the business, it's not one I'm too familiar with. Obviously, owning it, Ben knows it better than I do. But at a really basic level, like I would probably think about this business of if I can pay a reasonable price for that Australian monopoly business, then I can take the UK stuff as a bit of blue sky. And the Aussie business, low growth, still generated revenue at 10%. I mean, that's not a bad number, probably mostly driven by price and macro returning. But solid EBITDA, solid cash flow, as Ben highlighted. On my numbers, sort of 11 to 12 times sort of operating EBITDA to EV. Now, maybe there's some corporate costs behind that I'm missing. That's just the segment analysis, and there's some corporate costs to put on, but it wouldn't be too much different to that. I suppose the question marks the market's had since it spun out of Link and listed is the UK expansion. Even this half, another, I think, 20 odd million EBITDA loss. But as I said, Ben knows it better than I do, and sort of keeping a track of what's happening on the ground over there. And I agree with that last point. Like, to me, the thesis would be quite a simple one, which is a fair price for an infrastructure-like asset in Australia. And as long as you're seeing those green shoots in the UK, you're staying in this business. So despite not knowing it well, I'll say a buy as well, just because, even on back of the envelope numbers, I agree the valuation is not too steep for the opportunity that the UK could represent for them.
Double buy to start this program, and that was the stock of the day, PEXA.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.